All right, today we're going to dive into one of the most powerful and, yeah, potentially riskiest tools in all of high-stakes finance, cross-collateralization. This is a strategy that can seriously build fortunes, or, if you're not careful, bring them crashing down. It all depends on how it's engineered. So let's get right into it. So just imagine for a second, you need a massive amount of capital, right? But you really don't want to sell your best assets, your prime real estate, your company stock, maybe even your super yacht. So how in the world do you leverage all of them together for one single massive credit line? Well, that is the core question we're going to answer today. And to answer that, we've got to start with the core concept. We're moving way beyond simple, everyday loans here and into a much more sophisticated way of thinking about finance. This is where things get really interesting. At its heart, cross-collateralization is pretty straightforward. It basically means you stop treating each of your assets like its own little island. Instead, you bundle them all up into one powerful security package for a lender. Your entire portfolio becomes the collateral. In this slide right here, it really nails the difference. I mean, we all get how a normal mortgage works, right? One house secures one loan. If you default, the bank takes the house. Simple. But here, the lender isn't just looking at one single asset. They're underwriting your entire portfolio. That is a fundamental shift in how they see the risk and the opportunity. So how does this whole thing actually work under the hood? Well, think of these as the engine parts. You start with your pool of assets. Then you bolt on some really powerful legal clauses, things like dragnet clauses, which basically link all your debts to that one lender. And then there are cross-default provisions, which are absolutely critical, as we're going to see in a bit. Altogether, these things allow the lender to create a single blended loan-to-value ratio, which is what unlocks so much more borrowing power. Okay, so why would anyone go through all this trouble? How does this complex structure turn into a real strategic advantage? Well, it really boils down to two things: power and flexibility. I mean, the benefits are just huge. You can borrow far more than you could against any single asset alone. You get access to cash without being forced to sell your best investments, which is crucial, especially in a down market. And by consolidating everything with one lender, you just streamline the whole shebang and gain some serious negotiation leverage. And look, this isn't just some dusty old financial trick. It's becoming absolutely critical right now. With market values swinging like crazy, lenders are demanding bigger security pools. And as traditional banks are pulling back, these private credit funds are stepping right in to offer exactly this kind of flexible, powerful structure. It's really the perfect storm driving demand for these things. Okay, theory is great, but let's make this real. Picture this: a wealthy family office. They've got a really diversified mix of assets, commercial real estate, some hot tech stocks, the works. They've got a big idea for a new venture, but they're not about to sell off their core holdings to fund it. And boom, here's how they solve it. Instead of trying to juggle a bunch of different loans, they work with one private credit fund. They pledge the entire portfolio. The fund gives them a single credit line based on the combined strength of all those assets, and just like that, the family gets the capital it needs and their core investments stay right where they are, untouched. All right, let's switch gears to another super common scenario: a growing business. Now, this isn't so much about funding a new idea, but about managing the complexity and risk that already exists. You know how it is. A lot of successful businesses grow by buying other companies, right? But that often means they end up with this messy spiderweb of different loans from different banks. It's a huge headache and honestly a major risk. A cross-collateralized loan just swoops in and consolidates everything. One loan, one lender, one set of rules. It totally stabilizes the entire capital structure. Okay, so this all sounds amazing, right? Almost too good to be true. And, well, every super tool comes with a super risk. This is where the stakes get incredibly high. This is the catch you absolutely have to understand. And here's the thing: the very quality that gives this structure all its power, that interconnection, is also its greatest, most dangerous weakness. It leads to things like those cross-default triggers, where one tiny problem can infect the entire portfolio. Or it leads to trapped assets, where you literally can't sell something you want to because the loan agreement is just too rigid. Just read that again. Let that sink in. A default on any single obligation, no matter how small, can set off a chain reaction across the entire portfolio. This isn't just a risk, it's a potential time bomb that's hardwired right into the loan agreement. Let's actually visualize this, because it makes it so much clearer. So here you've got a healthy, diversified portfolio. Everything's green, everything's humming along. The real estate is solid, the business is profitable, the stocks are doing great. Everything is supporting everything else. It looks perfect. But now, watch what happens. A problem pops up in just one tiny part of the portfolio. Maybe it's a minor loan covenant breach, something that seems small. But that single issue triggers the cross-default clause, and like a virus, that default instantly spreads, putting the entire portfolio, even all the healthy green parts, at risk of being seized. That is the domino effect in action.
So after all that, how do you wield this incredible power without getting completely burned? Well, it all boils down to one single thing: the structure itself.
This, right here, is the single most important rule you need to remember. All the details, the release clauses, the default triggers, the valuation methods, all of it must be meticulously negotiated and engineered on day one. Because trying to fix a bad structure when you're already in trouble, it's basically impossible. Precision, beforehand, is everything.
There's a quote from our source material that just sums this up perfectly. The power here doesn't just happen. It has to be carefully, deliberately, and expertly engineered.
Which really leaves us with a final, crucial question for you. When you look at your own assets, do you just see a collection of separate items? Or do you now see the potential to engineer them into a single, powerful financial tool? That difference in perspective, that's where real strategy begins.